My neighbor Elena bought a rental property the same month I put money into an index fund and forgot about it. For years, she sent me photos of the house, new tenants, a fresh coat of paint, a sold sign on the place next door, proof her street was up and coming. I sent her nothing because there was nothing to send. Just a number in an app I barely opened. Last month, we finally sat down and ran the actual math. 20 years of it. Every dollar in, every dollar out, every repair, every fee, every quiet gain compounding in the dark. And when the numbers finished loading, Elena went quiet in a way I'd never seen before. Here's the part one keep thinking about. For most of those 20 years, she was winning. And then, without either of us noticing exactly when, she wasn't. I'm Sam. I think about the quiet side of money. The part nobody posts about, where wealth gets built slowly and almost invisibly. If you're new here, this is exactly the kind of video I make, so stay a minute. This one's worth it. Here's the single idea to hold on to for the next 10 minutes. Two investments can start dead even, and one of them can look like it's winning for years and still lose in the end, simply because compounding doesn't announce itself until it's already too late to catch. Let's make this fair. Elena and I both had $60,000 saved. Same age, same income, same city. She put hers down on a $300,000 rental duplex with a 30-year mortgage at 7%. I put mine into a total market index fund and set up an automatic $400 a month contribution I never had to think about again. On day one, Elena had keys, a tenant, and a story for dinner parties. I had a login screen. It wasn't close in terms of how it felt. By year one, something surprising was already true, even if neither of us could see it. Elena's equity, once you counted her mortgage payments and a little appreciation, sat right around $71,000. My account had grown to almost exactly the same place. Two completely different experiences producing the same number. She felt like she'd cracked the code. I felt like nothing was happening. Only one of us was right about that. By year three, Elena was still slightly ahead, and it felt earned. Her equity had climbed to about $96,000, plus a real cash profit of roughly $4,000 after you subtract what the napkin math conveniently leaves out. Property taxes, insurance, a water heater that failed in February, 2 months of vacancy between tenants because the first one left the place worse than she found it. My account, meanwhile, sat at about $98,000. Close enough that neither of us would have called a winner yet. But here's what nobody puts on the thumbnail. The rent check is the number everyone talks about at parties. What comes out of that check before you keep any of it is the number nobody mentions. Vacancy alone averages about a month a year industry-wide, a full mortgage payment with no income behind it. Maintenance runs 1 to 2% of the property's value annually. Capital repairs, the roof, the furnace, the water heater, arrive in 5-figure chunks every decade whether you saved for them or not. None of that showed up in the number Elena posted to her group chat. All of it showed up eventually, and there's a cost that's even easier to miss: her own time. If Elena had hired a property manager, that's 8 to 10% of monthly rent gone before she sees a dollar of it. Since she managed it herself to protect her margin, what she actually paid instead was a part-time, unpaid job. Late-night calls, weekend showings, a plumber coordinated during her lunch break. That cost never shows up in a spreadsheet, but it shows up in every evening she didn't get back. By year 7, without either of us marking the date, something changed. Elena's equity plus her real cash profit put her total around $165,000. My account, with 0 hours of management and 0 phone calls, had quietly passed her at about $169,000. Nobody sent a text that day. There was no headline. That's the entire problem with compounding. The moment it starts winning is invisible, and by the time it's obvious, you've already missed the chance to feel surprised by it. Quick gut check. If you were Elena at year 7, still feeling ahead, would you have noticed the moment it flipped? Most people wouldn't. Drop a comment with which one of these two you actually are, because the rest of this video changes depending on your honest answer. Here's the quiet lesson underneath all of it, and it applies to both of us, not just one. Researchers have shown for decades that the average investor earns less than the very investment they hold, because they don't just sit there, they react. Elena didn't react badly to To be clear, she stayed the course too. But she was competing against an asset that had one advantage she never had. It never got tired, never needed a repair, and never once asked her for a decision. By year 10, the gap had a shape you could see. My account was worth about $250,000. Elena's total, equity plus cash flow, was closer to $219,000. $30,000 apart and growing. She still had one thing I didn't: leverage. Her $300,000 property had appreciated to roughly $403,000, and her equity had grown faster, dollar for dollar of her own money, than mine did in percentage terms. That's the part real estate does better than almost anything else, and it's worth admitting plainly instead of pretending it isn't real. It's worth sitting with why this happened, because it's not the story either of us expected. Elena's money was working 2 jobs at once, paying down debt and riding appreciation, and for years that felt like the smarter, more aggressive move. My money was only doing one job. But that one job never stopped, never took a vacation, never needed a new roof, and it turns out one thing running without interruption for 20 years beats 2 things running with constant maintenance in between. And here's the part that changes everything if you let it. When I bumped my contribution from $400 to $600 a month around year 8, the math didn't just add up, it multiplied. In the market, more money in means more money compounding on itself immediately. In real estate, more money in usually means another mortgage, another tenant, another set of 2 a.m. phone calls. One path scales by typing a new number into an app. The other scales by taking on a second job you didn't apply for. I want to be fair to Elena's side of this. Because if I only showed you the downsides of real estate, I'd be doing exactly what every stock market channel does, to make itself look smart. Leverage is real and it's powerful. Depreciation lets real estate investors deduct a paper loss even while the property gains value, a tax advantage stock investors never get. House hacking, living in one unit while renting the others, can erase your own housing cost entirely. Something no brokerage account can do for you. Index funds have their own quiet risks too, ones people gloss over just as often. In 2008, the market fell nearly 40%. In a single month in 2020, it dropped over 30%. If my account had been worth $250,000 and I'd watched it fall to $160,000 in a matter of weeks, that's not a number on a screen anymore, that's a stomach drop. Most people don't sit through that calmly. Most people sell at the bottom and buy back in after the recovery, locking in the exact loss they were trying to avoid. Elena never had that specific fear. Her asset doesn't flash a red number at her every morning. By year 15, the curve had fully bent. My account, about $457,000. Elena's total, around $322,000. A gap of $135,000, and it was accelerating, not slowing down. This is the part of compounding that feels almost insulting for the first decade, and then stops being subtle at all. By year 20, here's where we landed. Elena's property was worth close to $542,000, her mortgage down to about $138,000, her equity around $404,000. Add her real cash flow profit after 20 years of real expenses, roughly $45,000, and her total sits near $449,000. My account, with total contributions of $184,800 across 20 years, had grown to approximately $799,000, nearly double hers, and I never fixed a faucet. If you take one thing from this video, take this. Elena didn't lose because she picked the wrong asset. Real estate made her a genuinely wealthy person by any honest measure. She lost the comparison because her asset required her constant attention just to stay even, while mine required nothing but my patience to pull ahead. The real trap was never the property. It was believing that visible effort and real progress are the same thing. So here's the promise I'd write down if I were starting today. I will not judge my progress by how much attention it demands. I will judge it by the number that survives every real cost, 10 and 20 years from now, whether I was watching or not. If you're leaning toward real estate, treat it like the business it actually is, and know you're trading time for leverage. If you're leaning toward index funds, automate the contribution, so it happens before your emotions ever get a vote. And if part of you still isn't sure which one you are, That's fine. Just don't wait 20 years to find out the way Elena did. That's the whole game. Not which asset is smarter. Just which version of you can stay calm enough for long enough to let the math finish the sentence you started. And if you're wondering what happens when you don't have to choose, when you own the property and run the index fund at the same time, that's a completely different video, and the numbers there might surprise you even more than these did. I'm already running that math for next week. I'm Sam. Stay calm, stay invested, and I'll see you in the next one.